I'd like to welcome Sheila Bair, former FDIC chair. Sheila, thank you for joining me today, the day where we're going to learn stress test results. But before that, OCC just approved 2 new rules. Right. And so there's a lot going on in the banking industry. The 2 new rules, real quickly, they're going to be allowed to invest in more risky ventures like venture capital funds, and margin requirements within the same firm on derivatives is going to be altered so they'll be able to save money. What do you think of those 2 rule changes?
Well, I think they're significantly in the direction of deregulation. That's kind of been the glide path we've been on for several years now, which I think directionally is the wrong way. And we're paying for it now in terms of the what we could have larger capacity for banks to deal with the current pandemic. These 2 specific proposals, I think, are ill-advised, especially as a former chair of the FDIC. It won't surprise you to hear me to say that that $40 billion that will no longer be in banks to protect them against derivatives exposures that their affiliates are imposing on them is no longer there. I think that increases risk to the deposit insurance fund. So no, I do think that's ill-advised. And the Volcker rule, you know, they've been loosening that for years now. It's been under constant assault. This, as I understand it, the rule change basically defers to banks to decide what's proprietary or not. We went down that road with risk-based capital because you remember we're basically letting banks decide how much capital they should have prior to the great financial crisis. So been there, done that in a different context. It's not a good idea. So I think very disappointing, but it is what it is. I'm getting used to it with the current. I respect all of them, but I think they are directionally so going the wrong way on all of this.
So you think that if we were as tough on the banks the last 6 months as we were the 6 months after the credit crisis, somehow this would have turned out better? It certainly doesn't seem like banks have been antagonists in any of the conditions of the coronavirus issues relating to the economy thus far.
No, that's not what I meant at all. Yes, absolutely. Banks did not cause this crisis. We hope that they are helping to be part of the solution. But my point is, over the past 3 years, banks have been able to pay out more in capital distributions, in dividends and buybacks than they've actually earned. So their capital levels have been going down. The Fed did not invoke something called a countercyclical capital buffer, which is designed to get banks to increase their capital buffers when you get at the end of a cycle. And there are a lot of good reasons to do that. And we're seeing them now because when you get into economic turmoil, whatever the cause, banks need to expand their balance sheets. People put more money in FDIC insured deposits. Governments the Treasury issues more debt to deal with the economic turmoil. That creates demands for reserve deposits. So you want excess capital in the system towards the end of a cycle as you're approaching potentially troubled economic times. So you can draw down without compromising financial integrity. And so we were not building those capital buffers going into this. And now we're giving them a lot of additional capital relief, which we can talk about, at the same time that we're allowing banks to continue to distribute capital in the form of dividends and in a discretionary executive bonuses when that capital should be retained on bank balance sheets so it can be lent out to the real economy.
Now, in March, the Europeans, of course, banned any capital out of the banks, both in the form of dividends and buybacks. Our banks voluntarily stopped the buybacks. So you still are definitely pushing back on the notion that you believe that dividends being paid out should cease, even at this point in the cycle.
Yes, because you think you need to understand the broader context. So the Fed and other regulators are reducing capital requirements right now. These stress tests, they already lowered the standards for the stress tests that are applying this year. Lael Brainerd dissented from that. That reduces Tier 1 capital by about $100 billion. So it's important to understand that. They've reduced the leverage ratio, which is about, over time, another $76 billion of capital, lowered the capital minimum. So they are rapidly reducing capital minimum requirements in the name of expanding balance sheet capacity. But a better way to expand balance sheet capacity is to retain capital. When you get into a crisis, banks need to expand their balance sheets. There's no doubt about that. There are 2 ways to facilitate that. One is to let them take on more leverage, become more financially unstable. But if you give them more leverage, they can expand. Or you can require that they retain capital. That supports additional lending capacity as well. You know, FDIC insured banks paid out $30 billion in dividends to their holding companies in the first quarter. That $30 billion had stayed in those FDIC insured banks. That would have freed up about $500 billion of expanded capacity to take those deposits in, also support government securities operations if the capital had stayed in the bank. But as a way, it's being paid up to the holding company. In turn, most of it's being paid out to shareholders, and that that makes them less resilient. So again, the Fed's approach is to reduce capital requirements, not to retain more capital to expand capacity, but to reduce capital to expand capacity, which makes banks more fragile. I tend to think some combination of both would be the right approach, but they've clearly decided not to put in the buybacks. To their credit, they voluntarily did it. The largest banks agreed to suspend buybacks, at least this quarter. I kind of think that was a no-brainer, Rick. I mean, how many people, how many companies impacted
I understand
doing buybacks right now?
Yes. Well, Sheila, we're going to have to leave it there. We're on a hard break here, but I do want to stress that I can't wait to see the results of the stress test to see if Mr. Quarles and the gang, yes, are going to put a halt to dividends or not.